So just to kick off, I would love to get to know the audience a bit more for the benefit of our speakers. Who here is a current student? Hands up. All right, all in the back, obviously. Who here is from government? No one. Okay. Industry professionals, bankers, consultants, where are you hiding? There you go. And any entrepreneurs? All right. Who here is hiring? All right. Okay, so wonderful. So good afternoon, everyone. My name is Johnny Devon, and I'm honored to moderate this panel on the important topic of the business of development, making private foreign capital work in Africa. Our discussion today centers around the intersection of domestic and international capital, examining how African nations can leverage both to continue fueling sustainable growth. From impact investing to structured credit, my favorite, we'll delve into the lived experiences of industry practitioners who are actually deploying capital in these nations. Joining me are four distinguished finance professionals: Andrea, a pioneer in impact investing; Franklin, a tenured private equity professional; Jeetu, a seasoned banker and debt capital markets professional; and Tejan, a former Google senior leader and venture capitalist. Everyone, round of applause. So to kick off, I would love to ask one of my favorite topics as a former banker: interest rates, default rate swaps, spreads, everything in between. Jeetu, could you help set the context between perception and reality? What do people typically get wrong when they're considering doing FDI in Africa?
Yeah, so it's a very good question. Look, I mean, I think when we think about sub-Saharan Africa and how it trades in the international bond markets, there is a bit of a premium that is applied, especially if I think about sovereign curves and where they trade. So if we look today, Angola trades in the 5-year probably around 11%. Nigeria is not too far away in the sort of 10% area. You've got your best sort of performing countries, Cote d'Ivoire, for example, which probably more in that 8%. And then you compare that to similar rated countries in emerging markets, there is definitely a premium there. Now, you may ask the question, well, why is that? Look, there is there's a sort of historical perception issue that is definitely there. There is the fact that the market is relatively nascent, so people are thinking about these countries as growth economies, and there have been a few missteps. If you think about Zambia, Ghana, for example, more recently, they've both had to go through quite painful debt restructurings, especially on the Eurobond side, where people have taken significant haircuts. What I do think is quite interesting, though, is that you've seen more recently in the last couple of years that actually the corporates and the banks have traded well inside of the sovereign. So typically what you would normally see in an emerging market is the corporates and the banks trading at a bit of a premium to the sovereign, but now these corporates are much better liked. And I think that's largely because you can de-link away from some of the FX risks. You've seen massive devaluations in Nigerian naira through the course of the year. And if you've got corporates which are operating in oil and gas, for example, yesterday we just priced a transaction for a large indigenous oil and gas company out of Nigeria that priced 50 basis points inside of sovereigns. So I think what you're seeing is that there is an increasing appetite for sub-Saharan Africa. Those premiums versus other emerging markets are coming down as people become more and more familiar with the countries of operation. And what you typically need to see is the more that the sovereign issues, the more people become familiar with the country, the more people are willing to invest in that country, the more access corporates and banks have from that country. And it sort of starts a bit of a self-fulfilling prophecy there.
Mm-hmm. Interesting. So I guess it requires a first step, right? So with that, Andrea, could you speak a bit more about what your LPs and your stakeholders think about and why you have been successful in building a career in the African subcontinent?
Wow, these are a lot of questions. I think one of the biggest problems right now, and these are really private capital markets we are looking at, is, and I think someone this morning described it quite well, initially Africa was sort of the the white spot on the map. Then we had Africa Rising, and then things didn't exactly work out as we expected. And now it's very, very hard to raise private capital for risk capital investments on the continent. So in a way, I have a DFI past. I worked for almost 20 years in a DFI context and impact investment context. And I think here we, in a way, failed our mission, because our mission was really to attract additional capital. And if I look where sort of the markets stand right now, it's very hard to see that we as DFIs were successful. So I think here we really have to think again about how we approach the market and how we can bring in also capital that is not only DFI, because I think Andrew Brown mentioned it, these pools of capital are right now not growing because of what's going on in the world. So it's really crucially important that Africa manages to attract additional pools of capital. And I think a lot of this capital should probably come from inside the continent, because Africa is building wealth. I mean, over the last 20 years, if you look sort of the amounts available or basically ending up in pension funds and insurance companies and all these asset managers, I think it's an important part of that sort of challenge we have right now, is to have more local capital into alternative assets. And I think it was mentioned before. If I now turn to sort of non-Africa based commercial institutional investors, for them it's very challenging, because if I, working in an asset management arm of an insurance company, come and suggest an investment in an African private equity fund, even one of the big names in Africa, how can I justify that? Because if I can have the same or probably better returns with considerably lower risk and also lower cost of doing these investments, because Africa is new, so we really need to go there, understand what these markets are, who is the best player, et cetera, so that creates a huge hurdle. And if something then doesn't go to plan, if sort of with a big, probably fanfare, an institutional asset manager is announcing their first investment into Africa, and that's not a terrific success story, I mean, the person who was championing that investment is probably losing their job. Whereas you do your next sort of PE investment in the US or in Europe, or probably even in sort of the more advanced countries in Asia, and if something goes wrong there, I think it's kind of normal and is sort of normal investment risk. So I think there are still a lot of hurdles to overcome. And I think one way to address it, and I think Andrew Brown already referred to it, is sort of blended finance. I mean, a way where public money is used to leverage in private capital. And I think here there are by and large two approaches. One is pure downside protection, first loss. But then, I mean, what kind of signal does that send out to the world? That basically, oh, a first loss is really needed. So that's probably not a good investment then, so hands off. So I think that's a bit of a problematic approach. And the second one is equally not without challenges, because the second one is say, okay, maybe we can do a little bit of return enhancement. So a commercial investor could probably get an additional return and a little bit of a type of risk premium financed by public money. But I think for public institutions, it's very hard to justify this kind of mechanism. So I think we still need to innovate and think in a more sort of in a broader way about how we could make this happen. And I think a second area is really impact investing. And that's, for now, still pretty much of a niche. And I think it's commercial investors usually struggle with impact investing. And I mean, I could say a lot about impact investing, but probably would stop here.
Okay. Thank you for those insights. I would love the counter thesis on that from Tidjane. We were briefly mentioning and speaking to this outside. You mentioned to me that you are not an impact investor. Can you elaborate?
Well, I should be wary of being counterposition to Andrea. But the reality is, as Andrea said, PE, fund managers in Africa, we all love to hate on DFIs, but we exist because DFIs. Most of our money comes from DFIs, and that have not changed. And we all want to attract more private capital, more commercial capital, to sort of expand the map. We're in this corner of the map where there's just not enough capital. And our approach has been that the only way to do this is to sell returns, performance. DFIs have been supporting us for the impact, and somewhat perversely, they've taught us to do impact. And we need to go find investors, commercial investors with returns. We've tried to do this. So in our first fund, we were very proud to tout that only 60% of our money was from DFIs. In our second fund, it increased because the fund grew a lot, and you realize there are only DFIs in Africa can put these big tickets in funds. So where else do you need to find the money? Institutions like insurances, when you're doing tech, so maybe I'm in this specific bubble, this universe called tech, and you're pitching these pension funds, it doesn't go well. You've said tech, you've said a lot of bad words. But we still, so the idea is still get them to do this small learning ticket, get them in. But so we've done that. We actually have Africa Rare as an LP, which we don't talk about enough. Go look for sovereign funds in the Gulf who are looking to deploy money, or try the ultimate holy grail, get a US pension fund. In general, our funds in Africa are too small for this, to be fair. If you're raising a $100, $200 million fund, you're talking to somebody who's looking to deploy 100 million tickets, it's tough. But what you find out is typically they have this small pocket of learning capital that you can tap into with 5, 10 million tickets. So you can get them in. We got one US pension fund, we got one sovereign fund, we got one African insurance player. But I think this is just sort of a test. The reality is we need to deliver returns for them to come back and double down and deploy the real tickets. And I think there is no way around it. We just have to, so this is why our first fund, to come back to what you were saying, our deck, we made sure the word impact never showed up in our deck. We told everybody, invest because you think there is enough returns for you to play here, or don't. It was a bit bold. But we still now, as the tech ecosystem, we've been talking a lot, we are very loud. We've been touting our growth and all. We've raised a lot of funds overall, collectively. We've deployed a lot of funds. We have not yet, I mean, maybe we are showing theoretical results, TVPI, but we haven't yet shown DPI. Mm-hmm. So this is our next big challenge. But I think if we do this, if we go and return this money, we provide liquidity with good returns, then we will be unlocking a lot of private capital. There is no other way, I think. We see a lot more, in the short term, there's a lot of capital to be raised by going after impact money, which comes with a lot of strings, which we already have, at least in the tech space where entrepreneurs are a bit more spoiled. We have a lot of entrepreneurs pushing back saying, why do you shackle me with all of this? Why do you want me to report on ESG 10 times, etc.? And who are saying, just, give me commercial money and let me work. We should do that as soon as we can afford it. Right. So the question is, when can we afford it? Meanwhile, we are very, very happy to work with impact LPs.
Perfect. We will come back to that, but I would like to fly across the pond to the United States and tap into Frank Linz's experiences. So from what you've heard so far, right, we have Jeetu talk about the overall risk premiums in doing business in Africa, and Rhea talking about kind of the impact aspects, and Tidjane not participating or blacklisting it, right? What did you see when you were, what do your LPs look out for, and why do they have the risk appetite to do deals in Africa?
Yeah, it's a good question. I think, first of all, I agree quite strongly with Tidjane and his whole ethos. And when we set up the business in 2016, as you said, from New York. I actually happen to be Nigerian American, so I consider our firm to be a bit of a hybrid. But, we set out with the distinct thesis of making Africa a destination for proper risk-adjusted return capital. So absolute return, people looking to make money. And the reason for that was really, really simple. You know, North America, if you just look at Canada and the United States, I think there's something like, you know, like a crazy number when you hear it, but it's like $400 trillion of institutionally managed money in some way, shape, or form, right? That's a big basket of capital, right? And when you look at the global capital landscape, right, and you add in the sovereign wealth funds, you add in the, you know, the Gulf, Northeast Asia, you know, big pockets of capital, you unfortunately are not going to access that giant basket of capital purely focused on concessional money, impact, you know, what I call sort of feel-good money. The reality is Africa is a place that has to discover agency in its own development. So in addition to being able to promote to these sorts of global capital holders, you know, risk-adjusted return, right, which is difficult because, as Andrea rightly said, I mean, you can get really good returns in places like America with a lot less risk. So how do you kind of, you know, bring someone into, you know, this kind of a story? You know, back at that time, I mean, a lot of it was around, you know, correlation or lack of correlation, right? So, you know, you had this diversification aspect to your portfolio construction, which is true, but the world's a big place and there are lots of places to get that, right? You know, there's India, there's Asia, there's Southeast Asia, lots of sort of emerging marketplaces to go. So I think the answers come in a couple ways, and you asked, you know, why are our investors interested? I think we did a few things that are a little bit unusual, which actually, you know, made it difficult for us to get DFI backing, if I'm honest. One was we were specialists, so we had a very strong aversion to the generalist philosophy. You know, similar to, you know, you don't want to have a seed investment in places where you've never been. I can't remember who made that comment, but I thought it was smart. You know, we can't know everything, right? And in Africa in particular, and I come from, I have a family background that's in industry in Africa, and having seen those experiences, you have to know, you have to have domain expertise to do well in Africa. It's not a place that has a lot of financial leverage. You don't have a lot of access to cheap credit. So you can't play games with your capital structure to make money. You actually have to know the unit costs of your business. You have to understand your production process in intimate detail. If you talk to any, I mean, TGI is here, right? If you talk to the senior people there, they can tell you this many tons per hour go out for this, you know, like the people who do well in Africa know their business soup to nuts, you know. So we decided to be very narrow in our expertise. The second thing that we were very focused on was, you know, you get a lot of pressure to look at the SME space, which I think is really important. But I think, again, given our original mandate was to look to large global pools of capital, you need scale, you know. And, you know, Tejani made a comment that, you know, we were taught to do impact by the DFI community. I think the other thing we were taught to do was look at really, really, really small transactions, really, really small absorbers of capital. And the reality is when you go have a conversation in New York or London to talk to someone about investments, they might even be on board with the general thesis you're talking about, but I don't have a pocket for a $20 million deal. I don't have any space for a $50 million deal. If you come back with a $200, $300 million deal, you know, come back and let's have a conversation. So since those kinds of opportunities don't necessarily exist, I think the next thing we did was that was a bit unusual, is we took a very proactive, and this was actually something we learned through experience. And we didn't start out this way. We started out, I think, thinking very typically around how you construct a private equity company. But we realized that we couldn't be private equity in the traditional sense. So we needed to have the flexibility and the capability to take businesses that were not at scale and work with them to get to scale, right? And almost venture build projects, which is what we do now. So if you look at us today, we have two internally held companies, Baylis Digital and Baylis Industrial, which are our two areas of focus, right? Telecoms and manufacturing. And we literally start projects from, you know, the ground up. We sometimes acquire, we sometimes put stuff together. But we know that the companies that we acquire at the front end, no one outside of our little space is going to care about or be interested in. So we have to do the things to make them investable, right? And we think that simply by creating, the governance standards, the scale, the business development expertise, et cetera, and then sort of talking about that to real money, we create value for ourselves, right? Because we're coming in and taking on risks that they will never do, at a scale and at a time in the sort of development horizon of the business that these people can't, they can't access that, right? They're not built to do that. And then taking them to something that looks and smells much more familiar and relatable to them. That process alone creates enormous value. The last thing I'll say is, it's a bifurcated point. I think Africa definitely needs a lot more African capital in the story. Everyone here said that. I think it's the most important thing Africa should do over the next sort of 10, 15 years, even before the executive order stuff. Because again, going to Chicago or Boston or San Francisco, and you're asking this allocator to commit capital to a part of the world that he or she knows nothing about, to be honest. And for better or worse, like it or leave it, I mean, what they do know is not good. Right? As you said, no one gets fired for allocating to Carlyle Fund 75, right? But Ubuntu Fund 3 in Uganda, you'll get fired, right? I mean, if that doesn't work, right? It's just the reality of life, right? So, and on top of that, you cannot ask people to, you have a dinner party and you put out a tray of food and you don't eat any of it, but you tell everybody else the food's so wonderful, right? So, and there's a sort of there's a bias to this, right? So if a person is an allocator and in the world of money, if they meet an African person, it's probably somebody wealthy, right? Mm-hmm. And so they're going to say, okay, your fund's so great, this opportunity, this project's so great. How come Dangote's not in? How come that I know there's this rich guy, he lives next door to me, he's from Africa, he doesn't put any money in this. Why are you asking me in Indiana to put money in? So there's that. But I think one of the things that we have had success in, and we can talk about this a little later, I'll just pause after this, is strategics. So corporate strategic money in specific domains. So for example, we're working with quite a few Asian companies now in food verticals, edible foods, animal feed, grain silos. And they might not understand Africa, but they're like, I understand how to build a grain silo, how that works, right? So if you can deal with the Africa stuff for me, I can do this project with you. So I think that's another area of some opportunity.
John, do you mind if I just jump in on that? So I think one of the things that I've heard on a couple of the panels here is the difficulty of finding equity capital to kind of go into Africa. I do want to just make the point that, between debt and equity, in the debt capital market world, there is no shortage of capital ready to go into Africa. We did a deal for Nigeria Sovereign in December, $2 billion deal. We had an order book of $9 billion. There is plenty of appetite. But I think the point that everyone is making, which I 100% agree with, is to get to the scale to access the bond market, that piece of capital is the real difficulty. Once you break through and you have significant scale to kind of access the debt market, the world's your oyster. We've done deals for a company last year called Africell, operates in Sierra Leone, DRC, Angola, and the Gambia. A bunch of countries where, well, putting Angola aside, a bunch of countries where the fixed income market isn't really that familiar. $100 million EBITDA company, not massive in terms of scale, did a deal, $300 million, well oversubscribed, people willing to take a bit of a gamble on a company which is growing, has a bit of execution risk, et cetera. But, I think that piece of kind of getting a company to scale is the most important bit. But then once you're there, the international capital markets in the debt space open up to you.
Interesting. So I guess you both have touched on the missing middle component, right? That seems to be a systemic issue even in Canada, North America, different countries, right? So solving for that is on top of mind for more or less everyone, right? Once you hit scale, everyone wants to do the business, it's been de-risked, right? But what is missing right now from, say, your portfolio companies that's perhaps prohibiting them from hitting that 100 million EBITDA mark and thereby unlocking institutional capital?
Who should start?
Andrea?
I think a big problem is, I mean, yeah, we discussed access to capital, but let's assume that's available. I think there's still sort of a lack of skills and expertise and labor force. I mean, if you really, and I think here is, in my view, a super great impact story. I mean, you make an investment in a company and that has a clear business plan to scale up. But you need to build your workforce. So I think it's almost an exercise for a fund manager like Franklin to help training and building that workforce, because you can't find it anywhere on the continent. So I think that's a huge task. And if you then think about from an impact logic, I think there's a lot to be said about it, because Franklin and the portfolio company are training probably massively a lot of people that for the first time have a formal job and generate a regular income. And I think we heard this morning about that every one person in an African family supports at least 5 others. So, I mean, bam, you have a massive impact. So I think this lack of skill and experience is a big problem. And then also what we found, there are some super impactful companies in pretty remote places. I was looking at the agricultural processing company in Nigeria, and this one, it was a beautiful business, and a fund made a small investment of roughly 1.5 million and really built up this company, but they had the hardest time to find a general manager, because no very capable general manager wants to work at the end of the world. It's just not attractive, and I think that also goes back to sort of that question of lack of skill and also managerial capacity.
Interesting. Do you want to?
I mean, I think the other one is really, and it's something that comes up a lot in these kinds of fora, but just the market integration in Africa itself. And both from a commercial standpoint, so the market you sell into as a business person, but also the capital market integration. So, for instance, just the ability for a Cameroonian business person to accept and transact and fulfill payments in Nigeria or right next door or Kenya or wherever. And so I think we've got this AFCFTA starting point. We've already had the regional economic communities for a while, but they feel to me like high-level exercises that are not sort of, bleeding down to the ground, right? The commercial activity on the ground, and from the missing middle, getting to scale. I think one of the best ways you get to scale is to have a big pool of consumers that are somewhat captive to you to kind of play with. So. The more we can integrate these markets and allow, because for instance, I mean, I think, the average African, very ambitious player is always looking to sort of sell outside, to earn hard currency and this kind of thing. But, I think there's, if the incentives were there, you could hopefully retrain people to actually, satisfy local demand and opportunities. And I think the way you encourage that is by sort of doing this market integration.
Interesting. I would like to bridge that over to a conversation I had with Tijan earlier, right? And we're talking about the technology sector as the area for potential innovation to help African countries leapfrog and catch up with Western countries. You had a different view on that as well. And you mentioned that building core technology should not be the mission. Could you further qualify that based on kind of what we have heard so far in terms of lack of skills and/or integrated marketplace?
I'll be possibly crucified for saying this, but as a tech investor investing in Africa, we typically do not invest in the technology. We are investing in the application of some very solid technology to specific problems to build specific business cases in Africa, but not creating new technology. Which is because we are investing in businesses. I was crucified at an AI forum because I said we are not investing in AI, and we will not. We will invest in some business case, and if it uses AI, great. Which then, but there is a lot to do. Like, you're doing fintech in Africa, you're not inventing any new technology really. But there is a lot to do just applying technology to digitize the continent, take these fragmented markets, organize them, create a lot of value, capture some of it if you can. There's a lot to do there. We are seeing some, to be fair, some cases. I was calling out when we were speaking earlier, one of our companies that is, building all of its AI in Enugu and selling it for customer experience in the US. They will never mention to any of the US customers that it's all built in Enugu State. Made in America. But it's all right. But this is still a few anecdotal cases, right? But I don't mind that. Our South African friends also will build from South Africa and expand to Europe. What's driving them is more what Frank was saying, looking for deep pools of customers where they can expand. So they'll go to Europe, they'll go elsewhere. But for now, we are investing in business cases. But on this difficulty to scale, just to come back on what we were saying earlier, and this actually is linked to what we were saying. If you want to build technology like AI, you need to tap into really deep pools of talents. And they're not right now mostly not sitting in Africa, to be fair about it. If you build this business, you're looking for deep consumers, you want to expand across borders, it's super hard. Despite all of these communities, everything that exists, it's just super hard to move from Nigeria to Cote d'Ivoire. And in my opinion, it is also a talent problem because the entrepreneurs to do this would probably need to go to this next level where you can structure complex deals, make acquisitions, consolidate, and we don't have much of that talent also. So there is a lot of talent here, entrepreneurial talent at play that we need to build. I was telling you earlier that I would happily open Senegal to every single entrepreneur in Nigeria because we need to import entrepreneurs. We don't have them, but in general, I think we need to import this talent somehow. We have a lot of African people sitting here who are learning this. Please come back. I'll fund you. Catch me outside. But there is this level of structuring that we just don't have enough of. In technology, we are so backward in finance. We don't know anything beyond a safe. So we have a lot to learn from you guys. But you don't talk to us yet because our companies are not profitable. We're growing. We have like $100 million companies that are not profitable, and Frank will not probably take our calls. So we have these fund managers, entrepreneurs, all of us, we have a lot to learn to get to that level. I'm not sure I know how we will do it outside importing it.
So the fundamentals of the ecosystem are there, but it's a timing issue and perhaps just a maturity issue.
We're all also very maybe impatient. I don't think you build these things overnight. Mm-hmm. You meet anybody in VC, they will be complaining that the ecosystem went from 5 billion to 2.5 billion between 22 and 23. But reality is, in 2016, when I started, it was $200 million per year. Right. So 2.5 billion over 8 years is pretty good.
Right.
We'll get there. If I'm being optimistic, we'll get there. You guys will get there.
Perfect. I would just like to touch on one core aspect for those, I would say, that are unfamiliar, right? How would you define to be the spirit of the African entrepreneur? And this is a question for everyone.
Wow.
I'm happy to start there because I probably sit on the other end of the spectrum here where I'm quite in a fortunate position. I get to see the success stories. Mm-hmm. When a deal comes to me or a corporate's about to raise money in the market, like they've been successful, right? And had the privilege of working with a number of different entrepreneurs who have built very sizable businesses in sub-Saharan Africa. And I think the thing that strikes me the most is just the focus and optimism of the opportunity. There is no shortage of opportunity in Africa, given the demographics. I mean, if you think about the TMT market, mobile penetration, et cetera, these are growing markets. It's very exciting, et cetera. And I think the tenacity of these entrepreneurs is phenomenal, right? Like thank you. I remember talking to a company which runs data centers in Africa, and they were saying, well, how's your day versus a European data center? And the problems that someone faces in Africa are different every day, whereas someone sitting in Europe, it's just a boring, tick the box, everything's working, it's real estate, it's fine, power's good. Don't have to worry about where I'm getting my diesel from, the generator's broken, et cetera, et cetera. So I think that tenacity to me is a thing that is really inspiring, and I continue to enjoy working with all these entrepreneurs, and I find it fantastic.
Interesting, thank you.
Just very quickly, I'll just say, just because you inspire so many thoughts, I would say resilience is definitely the watchword. I think everybody will say that. But also just, flexibility is key. And I think, before, when I started doing this, and I had a job very similar to Jitu's before doing this, and I was, bulge bracket banks, and coming back to Africa, there was a lot of humility around it, and I spent actually a lot of time working in companies that, again, we built a lot of companies internally, and I even spent some time in the government in Nigeria, very intentionally, because I wanted to understand not the sort of pitch book sort of sense of what it's like to run a business. If I, private equity is a very intimate relationship with the people you give money to, right? You're coming into a lot of these are family-held businesses. I really want to know, I understood what their life was like, and all I can say after doing that sort of education process was, every morning an African entrepreneur wakes up having no idea what's going to happen that day. That's the best way to describe it. Literally, I spent, years where literally every morning, anything can happen. People can get kidnapped. It could be a great day. The power doesn't work. Somebody died. You have to give them money. It's just like, it's like I make concrete, right? like this is my job, right? Like why am I, So I think that flexibility and resilience are probably the key watchwords.
Interesting.
We're going to sing the same song, huh? Yeah. I'm lucky enough to sit in a platform that invests across the world. We have, so consistently when we bring like 300 founders together at Partech, for the same stage, the African founders stand out, really. A Series A founder in Europe and a Series A founder from Lagos. The guy from Lagos or Joburg is far better, far stronger an entrepreneur. So if they're this good, it raises another question for me, which I think is a bit of a tragedy. There is a velocity problem. It takes us 3 times longer to get to the same place. So, these guys, G2C, they're not 30, they are 50 or 60 by the time they get to him. It just takes longer. So yes, you need tenacity, yes, you need resilience, but I think there is a sort of mission for us, because my point of view as a failed African entrepreneur is that the biggest benefit of capital is that velocity. We spent a lot of time making the capital we need to grow our businesses instead of raising it. And so we need that velocity, we need more capital.
Just to add one element I found always super impressive. I said before, I have been in development finance and impact investing for a very long time. And if I ask myself why, I think exactly it's sort of seeing the African entrepreneurs, understanding what they're basically every day doing just to keep the business alive and just to keep going. And they need to have a very sort of unique combination of being visionaries, because they really need to envisage something that is still quite in the far distance, velocity. It takes longer. They need to be very optimistic to basically keep going. And I think at the same time, they have to be super adaptable, they have to be super resilient. And just seeing all these combination in one person, was really then saying, okay, you have to go back home and make sure you get some fresh capital to invest, and really battling the Swiss bureaucracy and going through all these difficult meetings, and also having difficult conversations about impact and how much impact and how much ESG we can really kind of force on top of all the sort of everyday craziness African entrepreneurs are experiencing. And I was often pushing back and saying, guys, this is not realistic. If you have to think every morning whether you have enough power to keep going, then probably your climate impact is right now not your biggest worry. So, and I always try to find sort of a balance between these sort of different agendas. And I think the African entrepreneur, whenever I came back from Africa, back to Bern and sitting at my desk, I really needed that sort of exchange to keep going. So thank you very much. I learned a great deal of amazing stories from African entrepreneur.
Wonderful. All right. Unfortunately, we don't have time for questions, but you can reach out to our speakers here outside. Thank you once again to our speakers. I know I got a lot of good notes to take back to my LPs and potentially participate in Africa. And thank you all for the opportunity and the opportunity to connect with you all. Thank you.